Hey everyone, welcome back to Corporate Decoder. Tyson Foods Incorporated TSN just filed a report on a massive debt deal, and I am seeing some interesting signals about how they are managing their finances. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just borrowed a huge amount of money by selling new bonds. And understanding why they are doing this tells us a lot about their strategy. So what is going on here is that Tyson Foods, a giant in the food industry, has just completed a big public offering. They sold two types of bonds, essentially borrowing money from investors. They raised a total of $1 billion. That is a massive number. $1 billion split between two different debt agreements. One part of this deal involves selling notes that will mature in 2031, which means they promise to pay back the principal by that year. These notes have an interest rate of 5.100%. This is how much they have to pay investors each year on the money they borrowed. The other part of the deal is for notes that mature in 2037. These have a slightly higher interest rate of 5.600%, so they are paying more to borrow money for a longer period. Now, the company is using what is called an indenture to manage this borrowing. Think of an indenture as the rulebook for this debt. It outlines all the terms and conditions, like how and when the money will be paid back and what happens if things go wrong. These new debts are considered senior unsecured obligations. This means that if Tyson Foods were ever to have serious financial trouble and couldn't pay everyone back, the people who hold these notes would be among the first to get paid, but there are no specific assets tied to this debt to guarantee repayment. What is really important here are the restrictions or covenants that come with this debt. The company has agreed not to do certain things without the lender's approval. For instance, they have limitations on taking on more secured debt, which is debt backed by specific assets. They also have limits on sale and lease back transactions and on merging or transferring a large part of their business. These are common ways companies manage risk when they borrow heavily. This filing specifically falls under the category of creating a direct financial obligation. Essentially, Tyson Foods has taken on a significant new debt, and this report is its way of telling the public about it. The company is also providing legal opinions and consents related to this bond issuance. This is standard practice to ensure everything is legally sound. This includes opinions from their legal team, Davis Polk and Wardwell LLP, confirming the legality of these financial instruments. And in the exhibit section, you can find all the actual legal documents, the base indenture, the supplemental indentures, and the forms of the notes themselves. This includes the original base indenture from way back in 1995, showing they are building on their existing debt structure rather than starting completely fresh. Then there are the supplemental indentures that were specifically created for these new notes, detailing the terms for the 2031 and 2037 notes. And you can even see the exact format and wording of the actual bonds they are issuing. This report is signed by Kurt Callaway, who is the Chief Financial Officer. This is the person ultimately responsible for the company's financial operations. Looking at the broader picture, Tyson Foods has a market cap of over $20 billion. They are a huge player in the consumer defensive sector. Specifically in farm products, their P/E ratio is around 36, which is a bit on the higher side, suggesting investors might be expecting strong future growth. Recent news shows they are making other financial moves, like reaching a $1.2 billion debt buyback cap, meaning they are actively managing their existing debt. They also recently announced their second quarter results, which is important context for understanding why they might be raising new capital. Some analysts think the stock could be undervalued by as much as 35%, so this debt issuance could be part of a larger strategy to strengthen their financial position and potentially unlock that value. So why is Tyson Foods borrowing $1 billion right now? They've got a lot of employees, over 130,000, and they are a significant company. This move to issue new debt could be for several reasons. They might be refinancing older, more expensive debt, essentially swapping out higher interest payments for lower ones. Or they could be funding new investments, expansion projects, or even acquisitions. It could also be a proactive step to ensure they have ample cash on hand to weather any potential economic storms or to take advantage of opportunities as they arise, especially given that some analysts see their stock as undervalued. The fact that they are issuing this debt under existing indentures suggests a structured and planned approach to managing their capital. The interest rates 5.1% and 5.6% give us a clue about the market's perception of risk associated with lending to Tyson Foods. These aren't incredibly high rates, which suggests lenders generally feel confident in Tyson's ability to repay. However, the higher rate for the longer term debt in 2037 indicates that the market demands a premium for locking up their money for a longer period, as there is more uncertainty over a decade. The restrictive covenants are a key takeaway. They show that the lenders are not just handing over $1 billion without setting clear boundaries. These rules are designed to protect the lenders by preventing Tyson Foods from taking on excessive risk that could jeopardize their ability to repay the debt. For example, limiting secured debt means that if the company were to face serious issues, the lenders of this new debt would not be competing with other creditors for the same assets. In essence, this filing tells us Tyson Foods is actively managing its balance sheet. They are raising capital, likely to strengthen their financial flexibility, potentially fund growth, or manage existing debt. The terms of the debt and the accompanying covenants provide a clear picture of the lender's expectations and the company's commitments. It is a strategic financial maneuver in a competitive market. The risk I am watching is how these new debt obligations impact their profitability over the long term. Especially if interest rates were to rise further. My biggest concern is whether this borrowing is a sign of underlying financial pressure or a calculated move for strategic growth. What I am actually looking for is how this new debt will be utilized to drive future earnings and shareholder value. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe. Join our Discord for more insights.